This John Lothian News video is sponsored by Single stock futures have been around since 2001. How's that market evolving?
Single stock futures is very unique because it's a developing market, really. What we see single stock futures becoming is an alternative to the traditional financing angles, either through the OTC space, some of the prime brokerage offerings, but really opening the marketplace to a number of different clients. Basically, our clients can electronically trade single stock futures directly to UBS. And one of the questions we get a lot, or some of the concerns, something we hear a lot from the futures community is really, you look at the screen liquidity and there is no liquidity there. So the primary service that we're providing is we're allowing efficient equity execution and coupled with sort of efficient financing, wrapping that up into a product and block trading the futures for our clients. And that really is something that is bringing some nice liquidity to the exchange. Basically, there's two different contracts you can use. Really, everyone's focusing on the 1D contracts, and the main reason for that is to minimize the risks inherent in the contract, the dividend risk inherent in the contracts. So they'll ask us for a run of quotes on ETFs and single stocks. We provide that to them. They run their models with those bases attached, and what they're looking at is the underlying equity, as opposed to sort of the future screen liquidity trading itself. So they'll overlay those basis quotes on top of the equities in order to generate their signals. And then as those signals are actually being triggered, they'll send us orders to execute and start being involved in the market. And that's where we then will be hedging with the underlying equity and then posting a block when we're done in the futures price.
Who is using single stock futures today?
We're starting to see a lot more clients use it. Banks are using it in order to sort of efficiently find other financing alternatives instead of just holding, assets on their books. We also see some, hedge fund and long-short or macro accounts actually looking to move into that space as well, trading a few different products for financing alternatives. And one of the really unique things that we're actually seeing is right now, with rates so low, we see a number of different asset managers looking into the product as a way to get a higher yield on their excess cash that they might have. So basically offering financing for a wide range of the community.
What's next for the single stock futures market?
Over the next few years, 2 to 3, even potentially 5 years, the block trading will still dominate the volumes as people get more comfortable with the product. I mean, right now it's an education, right? For any sort of futures trading or managed futures account, even just understanding that they can access this. So that's going to take some time to digest. We do see that once you have these liquidity in the block trades, that'll bring more liquidity into sort of the screens. And then you have this liquidity begets liquidity and less block trading and more, either electronic or voice trading. But one of the interesting things that we are seeing is because of regulation and because of how, global regulators are really trying to get more transparent from the OTC space, OTC markets will be moving onto either centrally cleared or ultimately exchange traded platforms. And the numbers about what OTC exposures are right now are staggering. Whether we look at the Bank of International Settlements and what their estimates are, which is over $600 billion in just U.S. equity markets tied to OTC exposures, and that transitioning over some sort of time, or at least some of that transitioning over some sort of time, you're talking about, or you could really see, or even conservative approaches, extrapolate out some significant growth.